Going, everybody. Welcome back to another episode of Smart Money, Smarter Moves. I know it's been a few weeks since we talked to you. We had Thanksgiving, a busy November in the markets. And as you know, with this current president, there's never a shortage of action going on and things that we're learning. Excited to have our host, Kyle Cain, who's the CIO of our family office at Freedom Family Office, to give us the rundown of maybe updates over not only just this week, but the last few weeks. And as we get closer to the new year. So, Kyle, it's been a few weeks. You're busy managing client portfolios, but maybe just an update. What are you seeing over the last few weeks in the markets and anything someone listening right now in the car or somewhere important to know?
Yeah, so the past few weeks, November has been more volatile than we've seen since the Liberation Day, April sell off. Market's been pretty much straight up. We had it's only about a 5% sell off in the S&P last month, but more than that dramatically in some of the AI related cryptocurrencies, some of the higher risk, higher beta, higher valuation assets had even a more significant sell off. A lot of it was Fed policy expectations, right? What is the Fed doing with Fed cuts? A lot of people have heard of sometimes bad news is good news. You don't fight the Fed because the Fed, it, whether it's justifiable or not, does have some big impact on what market investors think is going to happen in the future, right? So, what sort of changed is the last Fed meeting and some commentary out of some of the individuals on the FOMC. A little more hawkish in the sense of, Jerome Powell said that December rate cut is far from a foregone conclusion. Then we had a few other, like I said, FOMC members say similar, that they are not in favor of a rate cut. So then the market started to price in about a 30% chance. It went from about almost a done deal, December of getting a rate cut, to about a 30% chance. And that's when we started to see the sell off happen. On top of that, there was some AI concerns as far as valuations and are we going to see a return on investment on all the CapEx spending. So just a few different things. Government was shut down, didn't have any economic data to back it up. So what's happened since? The sort of the end of November, we've had a bit of a rally here. Some of it, we got some economic data. We got September's, we didn't get anything of October or November's yet. And we're not going to get it before the next FOMC meeting. But we got September data, which was decent, showed that, employment was all right. Unemployment rate went up a little bit. We saw that inflation actually was down a little bit more than expected in September. But then we saw some other alternative job data, like the Challenger data that said that layoffs were significantly higher this past year and these past couple months than they have historically. So between a little bit worse than expected employment data, and then now we've had a few other FOMC members come out in favor, like the New York president, saying that he's in favor of a rate cut. Now all of a sudden, the expectations have switched back up to almost an 85-90% expectation. So that's really been driving most of the volatility. And as soon as that expectations change, the markets have rallied dramatically. So that's kind of a quick little setting. And November was able to squeak out with a gain on the S&P, but the NASDAQ was still down.
And with the markets still kind of hovering around all-time highs here, I something people talk about at the end of the year, and we're a tax-focused firm, is this idea of tax loss harvesting and maybe selling positions at a loss to help some tax mitigation. Is there anything you can share, like insights on that, that's really simple to understand? Like, are you doing anything at the end of the year with some portfolios with that?
So, I definitely believe that majority of investors out there and majority of your advisors, if you do have advisors, they really do only look at the end of the year to tax loss harvests. And, if you did it this year, are there still some securities that have a loss? Potentially, yes, but not very many. So we definitely believe that you can be doing it throughout the year, right? April was a good opportunity where you had, probably some losses in different positions when we had the large sell off, to take advantage, lock in some of those losses, immediately buy back alternative investments that, should go up when the rally happened, just the same, take advantage of it. There always is a little bit of end of year, thinking about other individuals that do their tax loss harvesting at the end of the year. Sometimes the winners keep winning and the losers keep losing. because they're selling their losers and not the gainers. That is, sort of a rule of thumb, but this year it certainly hasn't happened so far. Like I said, November, there was a bit of a rotation where individuals were selling their tech exposure and buying more defensive things like healthcare. So at the end of the day, it's more important, like I said, to do tax harvesting throughout the year, lock in those, and then, and stay diversified, rebalance, and, just focus on what the right investment is, regardless of what potential technical moves could happen at the end of the year.
Yeah, that's helpful. And what about, speaking of technical and news going on, talk to me a little bit about cryptocurrency. I know it's not something that we are, heavy on in client portfolios, but I know in the last couple of years, clients have asked you about exposure to cryptocurrency, whether that be directly through buying Bitcoin or buying the equities related. But you look at these stocks like MicroStrategy down 50 plus percent. You look at, I think Bitcoin went down to 80 or 81,000, way below its highs of 127. What are your thoughts on cryptocurrencies moves over the last weeks? And do you think there's a correlation with stock market related moves?
Well, so, Bitcoin it's looked as oftentimes like a gold alternative, the thought of the basement of the US dollar and our fiscal deficits. Bitcoin's going to be that savior. And, we've sort of seen that correlation isn't necessarily there. November, Bitcoin sold off quite a bit, where gold rallied about 6% in November. So, you can't always look at the traditional reasons on why Bitcoin is going to move. Again, it's an asset class that doesn't produce, any earnings or yield or cash flow. So it's just really about what individuals are going to pay for it. Certainly, with the little more pro crypto agenda out of the administration, as well as a little bit more institutional, access, and more firms getting on board that they have to start providing it, at least to their clients. I still think the trend of greater adoption and greater buying than selling. But we actually saw, like I said, in November, some of those, what they call the holders, right? The ones that are just going to hold on to it forever, that have these huge, um, you know, these huge wallets just that have never been touched, they did start selling. So some of those whales did start selling some of their Bitcoin when I got up to 127. So ultimately, like I said, it's, I think it is definitely a viable asset class at this point. I think it is, use these sell offs. Like I'll say, for some of the clients who does want exposure, I usually say, okay, that's not something that I can fundamentally evaluate. So hold the Bitcoin, outside of what I'm doing. But some clients insist. They just say, hey, I don't know what I'm doing. I'd rather you kind of do it. So for some of those, if we're just saying, hey, we're going to allocate a certain percentage, usually a small percentage. I was a buyer during the dip and the sell off. And like I said, I still think there's a place for more upside, but you have to be ready for the volatility. And like I said, just, I wouldn't live and die with your portfolio in Bitcoin, but having some exposure, makes sense.
You mentioned it's looked at as a gold alternative. I think I saw some data about gold either outpacing the S&P over the last, year or 30 years. But what about gold for investors thinking of gold? I know it's hot right now because of the year it's had, but I know it's not always like that. What are your thoughts?
Yeah, so same. We've had a gold allocation, for a while, and it's certainly done us well this year. However, same thing. I'm not really a gold bug. Overall, it's the same asset,
Right.
that same thought process, that it doesn't produce any yield, doesn't really have that much value as a currency. I mean, technically, so it's more of, just recently there has been some actual fundamental shifts that made it a viable asset class, in my opinion, again, which is ultimately, um, you know other global central banks buying it, right? So I do believe in supply and demand, and that's going to drive a lot of prices and returns. So once I saw that was a potential move, and again, there's plenty of reasons why they did it after sanctioning Russia, and again, deficits, and there's plenty of other reasons that kind of created a lot of these global central banks to And gold had just became the largest, central bank asset over treasuries for the first time, in a long, long time. So my point is that could continue if they think that, the dollar is going to devalue and there's other risks out there. I'm going to say it's not like, it's a doomsday type scenario. The dollar's going to fall, gold's going to, take over. Gold has significantly underperformed the S&P 500 for a long time until this most recent run, right? This most recent run basically kind of caught it back up. So same thought. I think it has a place after this big run up. You can't expect it's going to do another 60% year. Could it? It could, but I wouldn't have that expectation. Have it in there as a hedge against other potential dynamics. Um, but still, right, have the biggest chunk in companies that actually produce something of value and that you want to be a part owner in, right? Like NVIDIA's super volatile stock, but its potential is still huge, or it could, it could drop quite a bit. And like I said, it's better to you have the bulk of it, equities, but have some exposure to these things as hedges and alternative asset classes.
Yeah, and my last question for you, because I'm glad you mentioned NVIDIA. That's a hot topic where you look at a company like NVIDIA trailing a little bit off its highs of what, 212 or something like that. I think I saw it today around 180, December 5th. And, some people might look at that and say, yes, Kyle, I believe in the future. I don't have an amazing money manager like you to manage my money. And I want to know, do I just like buy in here with the nervousness that it could go down to like 120, 140? Like, what do you tell someone that wants to buy at these levels that believes in NVIDIA for the future but's nervous?
So, I mean, I think it's something I've been saying for a while. In certain technology like this, that is potentially like can just see how much money is being spent on the AI race. And it's impacting so many different layers of the economy that stocks that you may not even, and industries you might not assume um, really are directly related to AI. There's lots of studies out there where we're tracking the correlation of certain industries that are basically just kind of moving lock and step with the AI flows. So a company like NVIDIA, who had a stranglehold, had the greatest technology and was getting majority of this huge demand, like I said, the upside is potentially huge, and the valuation that you're paying for it is expressing that potential. However, just like in any technology, right? Google came out and and they've been creating their own chips for quite a while, TPUs versus NVIDIA's GPUs, and Meta came out saying they're going to build data centers using some TPUs. NVIDIA's chips are still involved, though, under the infrastructure of what Google's doing. So that became a scare that, okay, now, individuals, NVIDIA's chips are a lot more expensive than the TPUs are. So it's like, all right, maybe overall with technology, there's becomes efficiency, there's catch up from competitors, there's, things that hurt basically its pricing margin. And a company like that can fall dramatically. So my point is, I still think that they are ingrained in so many different aspects that NVIDIA should be a part of your portfolio. And having these sell offs is right, just another time to pick up some more shares if you feel like you're light on it. However, know that if you're an index investor, you already have a pretty high exposure to NVIDIA. It still is the largest, company in the world. And most mutual funds, ETFs, things like that have your overexposure. So know what you're owning. Know that a lot of these things will have higher exposure to AI that maybe you don't even know. And right there is the concern that the return on investment for all the capex doesn't pay off, and we see that continue that rotation of healthcare outperforming AI type position. So my best advice is, yeah, I still want to own it. I still believe that we're in the earlier innings. I still think there's going to be room for all of them to win for the time being, but eventually there's going to be winners and losers. And it's really hard for us to, unless you're talking to these companies every day and talking to consumers every single day, to know which one that is. So back to the taboo advice of diversify, but continuing investing and take advantage of things when they sell off, pick up some more shares. Once they run up a little bit too much, take a little of those gains off the table, reallocate elsewhere.
Right. No, I love that. You always give really just practical advice on it, especially for people that are nervous about that. Well, appreciate you coming on, Kyle, for our another episode of Smart Money, Smarter Moves, and we'll see you guys with another episode real soon. If you are interested in learning more about our services, go to freedomfamilyoffice.com. There's a contact us section, and you can learn about what Kyle is doing in more detail with managing client portfolios. We'd love to have a conversation with you guys. So thank you, Kyle, and we'll see you guys soon.